Hey everybody, how's it going today? Well, in this video, I'm going to talk about an option trading strategy that I like to use called the wheel. In my opinion, this is a great way to generate income in your trading account on cash that you are not using at the moment. Now, I'm going to go over exactly what this strategy is and how I like to use it right now. Now, before I get into it, I am not a financial advisor, so please do all of your own research. And if you are new to the channel, I like to find short-term and long-term trading and investing opportunities in typically lower-priced stocks. I like to look for undervalued, underappreciated stocks with high growth potential and talk about all other things finance-related as well. If that's something that interests you, please subscribe so you don't miss any future trading and investing ideas. Now, for those of you who are just getting into options, you may have heard of a strategy called the options wheel. The wheel is a great strategy for generating income with a lower risk than many other strategies. What really sets it apart from most other options trading strategies is its consistency and scalability, which can both benefit small and large trading accounts alike. Now, when trading options, always remember, no matter how much time you put into the research, the market will always remain unpredictable. Options are a leveraged trading instrument, and therefore it is important that you do not put all of your investment capital into trading options. The most important part of this strategy is to find a stock that you're bullish on and you won't mind holding for the long term in case you get assigned those shares. And the second part is to find a company that you can afford. Meaning, if you have $5,000 in your account, you need to find a stock that is $50 a share or less because you're going to be using cash secured puts. Now, I personally like to find stocks that are between $30 and $80 a share, but you can use any stock that you want as long as it has options. Like I said, we are selling a cash-covered put, and all that means is we have the money in our account to cover those shares if we get assigned. So if the stock is trading at $40 and we sell the $35 put and the stock falls to $34, they have the right to sell the shares to us at $35, so we must have $3,500 in our account to cover that. And here's the fun part. If you're doing this correctly, most of the time the contract will expire worthless and you get to keep that premium for nothing. And later on in the video, when I go over the option chain, I'm going to show you the criteria that I use that works the best for me. So the only way we can really lose money on this trade is if the stock completely crashes. So going back to the previous example of the $40 stock and we're selling the $35 put, if the $40 stock goes up to $45 at expiration, the $35 put expires worthless and we make money. If the stock only goes up $1 to $41 at expiration, the contract expires worthless and we make money. If the stock goes nowhere and closes at $40 at expiration, the contract expires worthless and we make money. And even if the stock falls 10% all the way down to $36 at expiration, the contract expires worthless and we still make money. And even if the stock falls under $35 and we get assigned those shares, that's not the end of the world. That just brings us to the second part of this strategy. Okay, so here's the part where it's important that you find a stock that you're bullish on and you don't mind holding for a while. Now, let's say that stock fell to $33 and you got assigned those shares, and now you have 100 shares of that stock in your account. Now, what you do is sell a covered call on that stock at, say, the $40 strike price. So if you're selling the $40 call every week, then that means every week the stock closes below 40, you get to keep that premium and the shares. Now, this works even better if you're using this strategy with a dividend-paying stock, but you don't have to. Now, let's say a few weeks down the road, that stock jumps up to $44 at expiration, and you have to sell your shares to that person who bought the contract at $40. But you paid $35 for those shares, so that's not so bad. Plus, you get to keep the premium from that week. Now, once this happens, you just start the process over and sell another cash-secured put the next week. Sounds simple enough, right? Well, like everything else, there's always risk. And like I said before, if the stock crashes, you could take a big loss, so you have to follow this stock rather closely and be aware of potential news coming out. And always be aware of earnings and try to avoid being in the option if they're coming out that week. I find it's just better to take that week off and start it back up the week after earnings, or maybe even find another stock to do this with that week. You also need to keep a close eye on the overall market. If the market looks sketchy, you might want to just wait a while before rolling out this strategy because it works best in a bull market. Okay, first I'm going to jump over to the charts, and I want to show you Invitae. This is the one that I'm going to be selling the put on today, and I wanted to show you why I picked this one. Number one, it is in an uptrend, and Invitae is in the genetic testing market, and I'm very bullish on this industry long term. So if I do get stuck, I do want to be in a stock that I have a good long term outlook on. But the put that I'm going to be selling is the $35 put, and the $35 put is right about here. And as you can see on the chart, I want protection for this put. I do not want to take possession of this stock unless I absolutely have to. I'm doing this strictly to earn income for my account while I have cash sitting in there. So we have this area of support that looks pretty strong. We have the blue line rising into it, which is the 50-day simple moving average, which it found support at just a few weeks ago. So if it comes down to that area, that could give it a bounce up to protect my put. Let me get this stuff out of here real quick. And as we can see, it is in a clear, well-defined uptrend. It is bouncing off of the 8-period exponential moving average, and this could easily be slingshotting it higher. So chances of it falling all the way down to $35. And the one that I am going to be selling is the put that expires next Friday. So there's about 11 days left on it. So the chance of it falling it all the way down to 35 are pretty slim. The earnings don't come out until the first week of November, so I don't have to worry about earnings. I'm not seeing any imminent news that could be coming out before next Friday. It's always possible, but just want to try to be aware of that. And you know, a lot of big investors, this is how they buy stock. They buy it by selling puts. You know, like Warren Buffett is famous for it, and so are a lot of other successful investors. Like, say they want to own Invitae, but they don't want to buy it unless it goes below 40. So what they'll do is they will sell that $40 put, and if it doesn't drop to below 40 in that time frame, they get to keep that premium. And if it does fall below 40, they wanted to own the stock anyway, so it's a great way that those guys can make money on the cash that they're sitting on. Like, people always make a big deal about all the cash that Warren Buffett is sitting on. Well, it's not like he's just stuffing it under his mattress. He is earning money on that cash, and this is one of the ways that he likes to do it. If he's bullish on a company and he doesn't own any of their stock yet, this is how he likes to put that cash to work. But as you can see, the stock is very strong today, and it looks like it could be slingshotting into higher ground any day now. So the $35 put looks pretty safe, but you know, being that so far away from price, the premium isn't going to be very high. But that's the price you pay for safety. So let's go over to the option chain, and I will show you what I like to look at there. Okay, so right here we have the option chain for Invitae, and this is for the options that are expiring in 11 days, so next Friday. And the one that I was looking at was the $35 strike price, and you can see you're only getting $20 a contract right now. I believe before I started the video they were at 30 and 35, but since Invitae is having a big up day, the value has come down because the chances of it falling to 35 has gone down. And the most important metric I like to look at when I'm selling premium is the delta. And the delta, if you're unaware, it is just the percent chance of it falling to that level before expiration. So you can see right here the delta here is 0.057. Let's just to make it easier, let's say it's 5. So there is only a 5% chance that price is going to fall to the $35 area according to the delta, and that's if the stock continues to fluctuate to the degree that it is as of right now. You know, anything can change. The market could start crashing, and that would have an effect on the delta. Or, you know, if news came out on Invitae that affected it, that changes the way the stock's been moving, that would affect the delta. But more often than not, it tends to stay right around the same. So If I took this trade and I sold this premium right now, I would have about a 95% chance of success on it. Now, because you have that degree of safety, you're only getting $20 a contract. So, it's a double-edged sword. You don't make a whole lot of money, but you're not taking on that much risk. Now, if I went to the $40 strike price, I'd be getting $70 a contract for each one that I sold, but my chances of success fall all the way down to, let's call it 18. So it falls all the way down to 82%. So it goes from 95% chance success rate to 82%. And if you want to take on that much more risk, that you still have a better than a 4 out of 5 chance of being right, but you're not really collecting all that much more premium. I like to play it safe. I actually like to sell premium right around a 10 delta, but you only have the 35 and the 40 to work with, so that delta jumps from 6 to 18. But it is a pretty safe bet as far as I'm concerned. Not only is it far out of the money, especially with how much Invitae fluctuates, but you have all those layers of support underneath it. You have that 50-day simple moving average climbing up to protect this put. So I'm probably going to sell 3 of these. I'm going to wait and see if the market trails off a little bit towards the close, and maybe I can get $25 to $30 a contract. It's probably not going to make it. The bid's probably not going to make it to 30, but it could certainly make it to 25 before the market closes. But that is what I am looking at. I just wanted to show you guys that trade, and I am going to probably do these every week. So if you want to follow along in the process, I'm going to show you the executions and stuff like that. So if you want to follow along in the process and learn how to trade the wheel and just see how it works, make sure you subscribe to the channel so you can keep up on that progress. But yeah, that is the basics on how you run the wheel. And maybe the stock will crash and I will get assigned, and then I will show you how to do the covered calls. And it never really bothers me unless the stock is really crashing if I get assigned. But also one thing that you can do, you don't have to take possession of the stock. Like if the stock starts crashing, and say I buy 3 of these and I'm into them for $20 a contract, and say like tomorrow the stock crashes down to say 38. Well, the value of the contract is going to go up, and this bid ask might go all the way to say $1 and $1.10. And if I don't want to be in this stock, I don't have to take possession. Tomorrow I can come right in and sell those contracts off, and just sell them off at $1 a piece and take my loss, and just start over. You don't have to take possession of the stock, but chances are when these things fluctuate, like a lot of times when I get into a stock and I'll buy the option, it'll go against me, say the next day, and then it'll get a little bit scary, because when you're down, say 200% really quick, it can be a little nerve-wracking. But it usually, if you give it time, it will it won't go down all the way to your strike price, and you'll end up being okay. Now, of course, that comes with a little bit of experience, and it's probably going to be a little nerve-wracking the first few times you use this, and you start getting close to being comes down to your strike. But I would just play this really small when you're getting started. Like I usually don't take a lot of risk on these anyway, just because you never know when the market is going to crash. But like I said, if it does expire below your strike, it's not the end of the world. Because, a lot of times when that happens, I just start selling covered calls above it, and I'll make all my money back, and then eventually it'll sell above where I bought it anyway. So I'll make money on that stock, and I'll be collecting premium the whole time. So it's definitely something you want to have in your financial repertoire, and you want to take it slow for sure. Whenever you're dealing with options, you want to take them real slow in the beginning, because they can be kind of confusing. But well, there it is, folks. That's what I have for you today. All right, guys. Well, there you have it. That's how I like to run the wheel option strategy. In the comment section, let me know if you already run it, and if you do, let me know how you like to use it. Because like I said, I like to use them probably about 2 weeks out or so. I know some people like to do them on a weekly basis. Some people like to do 45 days or more. So let me know how you guys like to do it, and if there are any stocks that you're using right now that are working very well with this strategy. Please like this video if you enjoyed it, and subscribe to my channel if you haven't already. Thank you so much for watching, and until next time, take care, everybody.